Welcome back to CFA Program Exam Preparation Series. This is study session number 7, reading number 21. Today's topic is dividends and share repurchases, analysis. 1. Introduction, payout policy, principles by which company distributes cash to common shareholders by means of cash dividends and share repurchase. 2. Dividends forms and effects on shareholder wealth and issuing companies' financial ratios. 2.1 Regular cash dividends. Distributing cash to SH on regular basis signal of company's growth and profit-sharing practice. Increase in regular dividends. 2.1.1 Dividends reinvestment plans, DRPs. 3 types of programs. A. Open MKT DRP. B. New issue DRP. C. Plans that permit either A or B. Advantages. 1. Low transaction costs for SH. 2. Low flotation costs for company. Disadvantages. SH require extra record keeping. Delta the cost basis for SH. SH have to pay tax on cash dividends even when dividends are reinvested. 2.2 Extra or special, irregular, dividends. Dividends paid by companies that do not pay regular dividends or paying extra dividends on some special. 2.3 Liquidating dividends. Dividends paid by companies that go out of business or sell some portion of their business on cash. 2.4 Stock dividends. Non-cash form of dividends, bonus shares. SH's cost per share decreases, keeping their proportionate ownership or total cost basis unchanged. Without spending real money, companies issue and SH receive additional shares. Stock dividends, increase in share outstanding, increase in shares owned, decrease in EPS, decrease in stock keeps P/E, total market value and ownership value unchanged. Difference between cash dividends and stock dividends. Cash dividends. Decrease in cash, decrease in equity, decrease in cash ratio, decrease in current ratio and increase in D/E, D/A. Stock dividends. Decrease in R.E, increase in contributed capital, total equity, liquidity ratios and financial ratios remain unchanged. 2.5 Stock splits. Are similar to stock dividends. Common splits are 2-for-1 and 3-for-1. Total SH's equity remains same under stock splits and stock dividends. Stock splits does not affect equity whereas, under stock dividends. Decrease in R.E, increase in contributed capital. 3. Dividends policy and company value theory. 3.1 Dividend policy does not matter. Dividend irrelevance theory. Dividend policy irrelevant for shareholders. Decisions related to FCINV and WCINV affect shareholders' wealth. Theory similar to Proposition I under perfect capital markets assumption. Dividend policy has zero impact on cost of capital or shareholders' wealth. Homemade dividends. An investor desiring to earn income can sell his/her shares. In case of avoiding income, one can purchase share from dividend income. When perfect market conditions do not hold, companies and individuals incur transaction cost in selling/buying shares. 3.2 Dividend policy matters, the bird in the hand argument. Even under perfect market conditions, investor prefers cash dividends over potential capital gains. Dividends are considered less risky. Ex-dividend price. Share price when share first trades without right to receive an upcoming dividend. States paying or dividend X divided price of share but does not affect risk of future cash flows. 3.3 Dividend policy matters, the tax argument. Dividend tax rate. Capital gains tax. Investors prefer low dividend paying stocks. If growth opportunities exist, earnings in excess of cost of capital reinvested. If no growth opportunities exist, excess earnings distributed through share repurchase. 3.4 Other theoretical issues. 3.4.1 Clientele effect. Investors' preferences for dividend policies vary. Young workers' time horizon, investment, prefer low or zero dividend payout ratios. Retired investors prefer dividend payout ratios. Some institutional investors only invest in dividend-paying stocks. Investors' marginal tax rate on dividend greater than marginal tax rate on capital gains, prefer investing in or zero dividend-paying stocks. If demands by clienteles for various dividend policies are satisfied by various companies' dividend market in equilibrium, changing dividend policy has no effect on share price. Dividend irrelevance theory. Marginal investors, investors expected to be a part of next trade important in setting price. Drop in share price is equals dividend amount if less than dividend amount if greater than dividend amount if. 3.4.2 The information content of dividend actions, signaling. Companies' board and management posses information can send signals through dividends regarding company's performance. Dividend initiation conveys positive message, represents future earnings share price. Dividend omission conveys negative message, represents future earnings problems. Dividend payout for companies. R&D requirements. Capital intensive. Business risk. 3.4.3 Agency costs and dividends as a mechanism to control them. Dividend payment may overinvestment agency problem. By paying dividend, management is left with cash to spend and agency problem. Growing companies in cyclical industries hold cash and pay or no dividends. Mature companies in no payout ratios. Dividends default risk cash cushion to bondholders. Dividends underinvestment in profitable projects. 3.5 Dividend theory, summary. Demonstrating exact relationship between dividends and value of a company. Many variables affecting value. Research suggests tax rates results dividends payout. Empirical support for bird in the hand theory. 4 Analysts consider whether a company's dividend policy matches reinvestment opportunities, client preferences, legal/financial environment. 4 factors affecting dividend policy. 4.1 Investment opportunities. Investment opportunities or zero dividends paid by a company. Internally generated funds important for high-tech companies. Utility companies usually have investment opportunities. Dividend payout ratios. 4.2 The expected volatility of future earnings. Earnings volatile, companies cautious in changing frequency and size of dividend increases. Managers determine target payout based on long-term sustainable earnings and are reluctant in dividends when increase in earnings is temporary. 4.3 Financial flexibility. Extremely useful during economic contractions. Companies may change dividend policy to maintain financial flexibility. Financial flexibility can be achieved through share repurchase. 4.4 Tax considerations. All else equal, investor prefer dividends when dividends tax rate less than capital gains tax rate. Some investors prefer capital gains even when dividends taxed. Capital gains tax not paid unless shares are sold. Tax basis stepped up to fair value at date of decedent's death and shares received by a beneficiary. Tax-exempt institutions like pension funds indifferent about dividend income or capital gains. 4.4.1 Taxation methods. Double taxation. 1. $%. Double taxation, once at corporate level and once at shareholders level. Dividend imputation. Dividends effectively taxed at shareholders rate. Earnings taxed at corporate level, then shareholders receive tax credit. Marginal tax rate of shareholder less than corporate tax rate, shareholder receive tax credit equals difference of two rates. Marginal tax rate of shareholder greater than corporate tax rate, shareholder pays tax equals difference of two rates. Split rate tax system. Corporate earnings distributed as dividends taxed at rate. Retained earnings taxed at rate. Effective tax rate equals corporate tax rate plus 1. Corporate tax rate, individual tax rate. 5 Payout policies. 5.1 Stable dividend policy. Regular dividends paid based on long-run expected sustainable earnings. Most common dividend policy. Uncertainty in level of future dividends. Dividends may even win earnings. Dividends at lower rate than earnings in boom years. Expected increase in dividend equals increase in earnings times target payout ratio times adjustment factor. And #1 *+ ##. 5.2 Constant dividend payout ratio policy. Fixed % of NI paid as dividends. Dividends affected by short-term volatility. Not frequently used in practice. 5.3 Residual dividend policy. Rarely used in practice. Funds in excess of current capital expenditures are used to pay dividends. Management can focus on positive investment opportunities. Uncertainty of future dividends, due to fluctuation, disadvantage. Investor demand return on equity. 6. Share repurchases. Transaction where company buy back its own shares. Treasury shares, issued earlier and later repurchased by the company. Cancelled shares, issued earlier, later repurchased by the company and then retired, cannot be reissued. 6.1 Share repurchases methods. 4 methods listed below in order of importance. Buy in the open market. Co-purchase shares in the open market. Common method. Company has no legal obligation, provides flexibility. Buyback a fixed hashtag of shares at fixed price. Co-repurchase specific shares at fixed price, typically, at premium. Adding fixed date makes it time efficient. Co-uses pro rata basis if hashtag of shares are increased. Dutch auction. A tender offer to existing shareholders by providing them acceptable price range. Each shareholder indicates the hashtag of shares and MIN price they are willing to sell. Co starts with the lowest bid price and continue to qualify bids for higher price until reaches the desired no of shares. Repurchase by direct negotiation. Co negotiates with a major shareholder to repurchase shares. Reasons behind such transactions may include preventing large block of shares from overhanging the market. Activist shareholder getting control over the board. Hostile takeover attempt. 6.2 Financial statements. Effects of repurchases. Balance sheet. A. Repurchase with surplus cash. Assets decreased, equity decreased, leverage, debt ratios, increased. B. Repurchase with debt, debt equity decreased, leverage, debt ratios, increased. Debt ratios even worsen more. Income statement. Repurchases may increase, decrease, or have no effect on EPS depending on how the repurchase is financed, internally or externally. 6.2.1 Changes in EPS. If repurchase is financed internally, post-repurchase EPS will be increased than pre-repurchase EPS if rate of return on retained earning is decreased than cost of capital. For repurchases with borrowed funds, financed externally, post-repurchase EPS will be increased than pre-repurchase EPS if earning yield is than cost of borrowing. 6.2.2 Changes in book value per share. After share repurchase. When market price per share greater than BVPS. BVPS will decreased. When market price per BVPS will increased. 6.3 Valuation equivalence of cash dividends and share repurchases, the baseline. Shareholders' wealth remains unaffected whether co-repurchase shares or pay cash dividends, of equal amount, assuming other things constant. 6.4 The dividend vs share repurchase decision. Rationale for share repurchase vs cash dividends. Compared to cash dividends, share repurchases has tax advantage when tax on capital gain is decreases than cash dividends. Generally, when economy is strong, recession, repurchases goes up and down in value. Repurchases by borrowing funds. Increase EPS when post-tax debt cost less than earnings yield of the shares, before the repurchase. Decrease EPS when post-tax debt cost greater than earnings yield of the shares before the repurchase. It will not change EPS when after-tax cost of debt equals earnings yield of the shares before the repurchase. 7 Global trends in payout policy. Compared to European companies, less of U.S. companies pay dividends. In developed countries, fraction of companies paying cash dividends is while share repurchases have increased. 8 Analysis of dividend safety. Dividend payout ratio equals ratio risk of dividend cut. Dividend coverage ratio equals ratio risk of dividends cut. FCFE coverage ratio equals 1 co-returning all cash to shareholders. Ratio greater than 1 co-liquidity. Ratio less than 1 co. Paying out more cash, therefore decreasing its liquidity. Financial leverage risk of dividends cut. Dividends yield difficult to sustain. Stable or dividend positive signal. Dividends cut and past negative signal. Thank you everyone. We hope this information is useful to you. If you are willing to continue with these lessons, subscribe to the channel. To find more videos, quickly like and share the videos. You can also ask the question in comments, we will happy to answer. Here is some glossary to understand the lecture. Our topic finished here, let us meet in new topic.